So are you saying that what we have seen this week is Donald Trump's Liz Truss moment for the United States?
I'd rather call it a read my lips moment. George Bush, 1988 convention speech written by Peggy Noonan, famous for writing speeches from Ronald Reagan. She said the biggest takeaway was when he said, read my lips, no new taxes. 2 years later, as president, he raised taxes because the interest on the debt reached a record level, 3.2%. That stands today. That'll be broken next year. I say it's a read my lips moment because George Bush had to do something that was anathema to the party, make a politically difficult decision to raise taxes. So today, we see with societal upheaval, stress related to difficult choices that we have to make because of the high level of indebtedness. And so we'll have more of these read my lips moments ahead, stress regarding how much to raise taxes, cut taxes, spending, etc. So lots of difficult decisions that have to be guided and managed very carefully and communicated well so the markets understand where we're headed.
Tony, how do we get from a read my lips moment, though, to a Liz Truss moment?
If there's complete ignorance of what the bond market is concerned about, I would think that you would have that moment. But so far, you see some relenting to the bond market, and the James Carville-like. Remember, he said, of course, he'd like to be reincarnated as a bond investor because he can intimidate anyone. If anyone, if the policymakers decide to say no to the bond market in the sense of allowing inflation to rise, so the Federal Reserve could permit it, could create that moment, but it's not. And that's why you see Fed Chair Powell being very slow and gradual and prudent about rate cuts, because it's the right thing to do, because high inflation would be saying something very negative to the bond market. So I think it's if we go on a fiscally irresponsible path, you'd see the bond market pushing back. And what I would expect then, the final word, is a hall of mirrors effect, where not only are investors looking at policymakers, but policymakers are looking at markets because they matter a great deal now with the high level of debt that the U.S. has.
Aren't we there right now? Policymakers looking at markets? Donald Trump even talked about that the bond market was a bit queasy overnight.
It happened now, but in a multi-dimensional game of chess that you know Donald Trump plays, if you think he's thinking that, then you've got to think something else, perhaps. Who knows? So it may be the case that policymakers are looking. And the big signal this week from policymakers in Washington and Trump's team of rivals is the ascension, if you will, of Scott Bessent, the Treasury Secretary, speaking more in a calm fashion in ways that we're used to, Rubenesque, you could say, as we saw under Bill Clinton and Robert Rubin as Treasury Secretary.
We were speaking with Greg Peters of PGIM Fixed Income earlier, and he said that this week really has been a game changer for him, that he can't put this back in the bottle. You can't unsay certain things, and that this really is making him rethink the role of treasuries as a safe haven asset, given that if the goal is to reduce trade, then essentially there will be less dollars overseas to invest naturally in U.S. treasuries. Are you thinking about something similar?
Yeah, and I was looking this morning, and anyone could, on the IMF website, the COFER data, COFER data. It shows how much of the world's $12 trillion in reserves is put in the U.S. dollar. The figure is today 58%. It's been in decline. The next closest nation or set of nations is Europe at 20%. For the Chinese currency, there's fewer dollars or reserves in its currency than in the Canadian dollar. And so one other point to make, though, that's just the background. If you lined up friends and foes of the United States, and I don't mean to put anyone in the foes category, but just deemed or perceived as foes, you'd see that the nations that are friends would have still have account for about 60% of world reserve assets. So if each of the friends and foes went to their respective corners, you expect that the amount of money held in dollars would still be roughly the same, close to 6%, if it went to the extremes. That's one major point. The next one is liquidity. Of course, the U.S. bond market this week has seen, according to the New York Fed, $700 billion or so of daily volume. No market comes close to that. This isn't to say that over time we couldn't see that 58% of money held in dollars decline, and you have a plurality. 49% in dollars, more in euros, more in the yen, et cetera, et cetera. It's possible, and it'll be gradual. I wouldn't expect it to be immediate.